Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as a Chief Executive Officer of Treasury Consulting LLP, and we are making this video on the 25th night, which is the Christmas. So, first of all, we would like to, on behalf of Treasury Consulting LLP, we would like to wish you a Merry Christmas. Have a great holidays, and have a great, fantastic 2017 for yourself and your family, your personal, your company, and your organization. So this is a wish which Treasury Consulting LLP is imparting at 8 p.m. Indian Standard Time on Christmas. Thank you. And as you very well see that our YouTube channel keeps bringing new videos to you. So today we are covering this video a very interesting topic, which is interest rate derivative. There are two purposes of covering this video. First of all, to be honest, from the last 2 months I was thinking to cover this video, but somehow not finding the time. And secondly, you know that my book is coming, which is in third week of January 2017, and hopefully that will publish in US by a US publisher, wherein we are also covering this topic. So forward rate agreement is a very interesting topic, is in interest rate derivative, but unfortunately a very neglected one, and especially in India. Because what we tend to believe that what I saw, because I served as a corporate treasurer, most of them for 10 years, I saw that people have a highly reluctance towards interest rate derivatives, towards forward rate agreements. But before moving ahead, let me clear a doubt for you, which is FRA, forward rate agreement. Please be note that this is not a forward rate, a forward rate contract, because a lot of time when I spoke in international conferences and with the people to whom we are giving the consulting services in foreign exchange, they asked from us that forward rate agreement is nothing but the forward rate, which is the currency forward rate. No, forward rate agreement is a pure interest rate derivative contract whose job is to protect you to an extent, not fully, to an extent, from the increase in the interest rate exposures, if on the exposures which you schedule to take. So first of all, I will read this definition and then I give you little bit examples. This particular presentation was divided into two parts. So first part would be majorly practical theory, and second part I will take you that how forward rate agreements are denominated, what are the various tenors of forward rate agreement, and at the end we will take you towards an example. So here we go. A forward rate agreement, or a FRA, is an agreement between two parties who want to protect themselves against future movement in interest rates. FRA is also amongst one of the interest rate derivatives to protect against probable assets and liabilities. Remember the fact, there is an unfortunate, it's highly unfortunate perception we have in the market that forward rate agreement is all about liabilities. No. Forward rate agreement is about asset also. The point is simple. If you are on the liability side, you will buy it. If you are on the asset side, you will sell it. That is the point. So I repeat, forward rate agreement is about both. It is on the asset side, it is on the liability side. If it is on the liability side, you will buy it. If it is on the asset side, you will sell it. Moving further, by entering into the forward rate agreement, parties lock an interest rate for a stated period for a time starting on a future settlement based upon a specified notional amount. The very beauty of the forward rate agreement is that it is traded in almost every currency pair. You name dollar, Australian dollar, New Zealand dollar, GBP, Euro, Swiss franc, Japanese yen, Chinese yuan, Indian rupee, your I would say Singapore dollar, Romanian RON, Czech crown, Aussie dollar, your Thailand baht. It's traded almost in every currency. Forward rate agreement is amongst the most liquid interest rate derivative market we have in the globe. Like if somebody would ask you that which one is the most liquid interest rate market in this globe, this is OIS, overnight index swap. But that is especially US dollars and others. But forward rate agreement, shortly known as FRA in Indian terms, Indian bankers shortly term this as a FRA. Then forward rate agreement is amongst the most liquid interest rate derivative market of the globe. In the next part, we will also link forward rate agreement is one more agreement, which is euro dollar exchange rate futures. If you carefully see forward rate agreement, you can also make euro dollar exchange rate futures. This is the beauty of the forward rate agreement. Moreover, another beauty of the forward rate agreement is that it covers your probable assets and liabilities. I'm not talking about assets and liabilities which are in the book. Because unfortunately, what companies tend to believe, here is an example. Suppose in India we have a term called oilers. Oilers means all those oil companies, those who are buying and selling of the oil. Example, Reliance Industries Limited, HPCL, BPCL, Indian Oil, SR Oil, and others. Now these companies have a huge amount of working capital exposures, and why they need working capital exposure? Of course, oil is a big game. You first take the money, you invest it, you bring the oil out of the earth, and then you will sell it, and then you get your money. So it's a big game. It's a capex industry. So first you need to set your money, and then you will get your money. Now in case of that, people always believe that in Indian context, they are looking for a money, and that money is known as ECB. ECB stands for external commercial borrowing, which they are looking for. And what companies think that now once we have ECB, we will hedge that. How they would hedge that? 99% people hedge using forward contracts, and few smart treasurer hedge using option contracts. Now there is a difference between ECB and FRA. The people who are taking ECB, external commercial borrowing, they hedge using forward and option. There are few treasurers we have who left it open. Although RBI has put out strict norms to hedge the ECB, and banks now need to make more reserves. The provision of the MTM losses in their books, henceforth they are before the client to hedge the ECB, but that is out of the discussion now. But FRA can be used in ECB. How? Take an example. Suppose you have an oil company called Reliance Industries Limited who wanted to have, say, $3 billion of loan in LIBOR, and they are expecting that they will take it after 3 months for 12 months. Now they know that they will take $3 billion of a loan in LIBOR terms, and they will take after 3 months for 12 months. Assuming the credit spread of Reliance Industries Limited is 50 basis point. I'm not going to use credit spread, I'm going to use a technical word which is QSD, quality spread differential. Assuming the credit spread is 50 basis point, in that sense, what would happen? Reliance Industries Limited would always borrow at LIBOR plus 50 basis point. Now we know, sitting today, which is 25th December 2016 on Christmas Day, people know that 2017 LIBOR will move up. Fed has clearly said that in 2017, if the data is going to be good, and of course Fed is always a data dependent game. If the data is going to be good, they are going to hike interest rates by at least 3 times. It means that the LIBOR would move up. How you would protect yourself? Would you continue to put yourself open, or you are going to take the position now? You won't keep yourself open. You will take the position now, which would offset you towards some hike in the interest rate, which is probable in near future. Because you know that now the federal fund rate is 0.50. By January, we are expecting another hike. If not hike, then at least the hawkish tone. And I am expecting by February or March, the Fed will hike again. And in the next year, they would be hiked by at least 4 times. At least 3 times hike is something which market is factored in. Now, how would you do that? 99% corporate treasurers, what they do, they will simply sleep and they will say, okay, when the time will come, we will hedge that. Excuse me, here you are doing the wrongest stuff. Because you are supposed to hedge that sitting today. And that is what you can do using forward rate agreement. It means you are hedging a probable liability in the books. You are not hedging a liability, rather you are hedging a probable liability in the books. The best benefit of the FRA is very simple. Suppose you don't end up with the loss. Suppose you don't end up with this. Suppose after 2 months, Reliance Industries Limited thinks that, okay, fine, we were thinking to have $3 billion of the loan, say for Jio, Reliance Jio. Now we don't need that. Okay, so they are not in sync with the money, and they don't want to go with that. You simply settle this. There is no obligation here. No obligation in the sense like there is nothing which Reliance will deliver. There is nothing which bank will pay in the case of gain, or there is nothing which Reliance will pay or the bank will deliver in the case of loss. So it's just the settlement of the final gain loss. This is the beauty of forward rate agreements. To wind up this video, Forward rate agreement is an agreement between two parties. It is one of the beautiful topics of the exchange traded derivative, beautiful topics of the interest rate derivative. It is also to an extent can be used as a counter against exchange traded derivative futures. But unfortunately in India we do not have much exposure in exchange traded derivative interest rate futures. We have to go to other part of this world, which is CBOE, Chicago Board of Trade, CBOE, Chicago Board of Exchange. Here you have LSE, London Stock Exchange. Here you have a lot of exposure in interest rate derivatives. And to an extent forward rate agreements can also be synced with the treasury swaps also, and CMS also, which is constant maturity treasury swaps. So that is not a very difficult problem. The two beautiful traits of yours forward rate agreement is that it covers the probable asset and liabilities, and also it is amongst the family of the interest rate derivative. Before winding up this video, how it covers the probable asset: suppose Reliance is expecting a payment of $1 billion from I would say from one of its clients, and Reliance is expecting that LIBOR will move up. Now they yet to receive this money. Forget about cash flow hedging. Now I'm not talking about that they are expecting a payment, they using a cash flow hedging, they will cover this dollar into INR using a forward contract or an option contract. So if Reliance is expecting a $1 billion and Reliance is having a cash flow situation that they won't need this $1 billion for next 3 months because all of their oil imports has already been met. So $1 billion is a free money. What Reliance would do, Reliance will surely invest this money. But if Reliance today will invest, Reliance can only invest this money provided they have that in their books. But they don't have this in their books right now. They will get their money after 3 months. And they do not need the money 6 months from today. It means 3 months, after 3 months, for 3 months, which is 3 into 3, 6. They won't need that. How they can protect yourself from interest rate when they know that LIBOR is inching up, when they know that Fed is hiking the rate. So how they can make the money without receiving the money? This is the beauty of the forward rate agreement. It is a highly unfortunate situation that after overnight index swap, the most liquid interest rate derivative in this globe is FRA, but still majority of the people don't know about it and people don't know how to value it. Before winding up this video, we would like to clarify this fact that this video is not talking about FRA strips. We are making a separate Excel file. In fact, we are not sure whether we would demonstrate on our YouTube channel or not, because we wanted to make it a Bosch game in our upcoming February 2017. And we will see whether we would be able to bring FRA stripping in the form of the Bosch game or to YouTube channel. But let us see how the things would move. So this is what all about interest rate derivative, and in the second part we will take you towards more nitty-gritties of forward rate agreement. We are very pleased to share that we have our own online academy, which is TR Consulting, and we are offering almost 16 to 17 courses using online. We are very soon starting with the offline also within and outside India. Our corporate presentation is very well available on LinkedIn, very well available on YouTube in the form of a presentation. In case you need a corporate presentation, you simply write to us rahul.magan@treasuryconsulting.com, treasuryconsulting.in. I repeat, rahul.magan@treasuryconsulting.in, and we will share our corporate presentation with you. Currently this company is offering several things: trainings, publications, analytics and all. We are also very pleased to share that Treasury Consulting LLP would be the first company in India who would have the online Bosch games effective January 2017. Sitting today, there is no company in India who have online Bosch game, and we are launching 3 Bosch game in January 2017. The one we are launching in foreign exchange, which is mark-to-market valuation using IFRS 9. Another we are launching on fraud analytics, which is one with the Benford and one with the RSF using Benford. And we are currently evaluating the rest topics, that because in the next year we wanted to have more than 15 Bosch games which we continue to sell. We will see how we can do that, but yes, we are evaluating that FRA, which is forward rate agreement stripping, would again one of the Bosch games. You're always welcome to contact us at 9899242978. My email ID is rahul.magan@treasuryconsulting.in. Our website is www.treasuryconsulting.in. So we thank you very much for sparing your time. This is the first part of the video. The second part on the way, in which we'll take you towards the nitty-gritties of forward rate agreement, FRA. Thank you.